back. So for today, we'll be doing introduction to Japanese candlesticks. Just before I start, can I just check that, can you guys hear me clearly and can you see my screen? If you can you just put 1, 2, 3? Okay, yeah. Thank you so much, Kai-Ying and Kian-Ming. Okay, so for today, I'll be covering our introduction to Japanese candlesticks. Along the way, if you guys have any questions, please just pop them under the questions chat. Okay, so in this webinar, I'll be covering on basic bar formations. Okay, and also basic candlestick formations, as well as reversal candles. We'll also be showing you guys the different candlestick formations. Okay, so we have a few different types of charts basically. So we have bar charts, right? So bar charts, we have what we call OHLC, so open, high, low, close. Okay, so how bar charts are being formed, it's basically through this. So we have the highs, the lows, as well as the open and close. So the distance from the high to low represents the range that the prices are trading in. Okay, so this is the range from high to low. And it allows the traders to identify patterns easily. So you can compare two consecutive bars. So we have reversal bars, or what we call key reversal days. Okay, so for example, this is the bar chart. So one of these patterns is the key reversal. So we have a bearish key reversal. Okay, so basically the idea is that for a bearish key reversal, it's formed at the market top. And usually it's recognized with prices surging to a new high. And it's usually significantly higher than the previous trading day. Okay, so for example here, okay, so it's much higher as compared to the past, and it will only reverse lower and close below the previous bar. Okay, so this is one way to identify just based on bar charts. And also we have a bullish reversal. So same thing, bullish reversal is formed at the bottom of a decline. And it's recognized with prices first collapsing to a new low. So it pushes lower and then it's followed by a recovery to the previous bar's high and closing up on the day itself, or on the day. Okay, so yeah, these are bars. Usually I would say that like we have very few traders trading with bars. Most of them are doing with Japanese candlesticks. Okay, so on top of just key reversal pattern, we also have key reversal day. So we want to take note, like for example, at the end of the week, on Fridays, we have traders like intraday traders or people who do not want to hold their positions over the weekend because of much exposed risk. Okay, so people will close their positions. So that could lead to a pullback as well. So something else for us to take note of. Okay, we have key reversal bars, so two bar key reversals. So we have a bearish 2-bar key reversal. So again, this occurs at the market top and it's recognized with prices opening at the same level as yesterday, but closing lower with the same low as the previous bar. For example, like this. Okay, so the psychology behind this is that prices fail to make a new high. And you also have a bullish 2-bar reversal. Okay, so usually this occurs at the market bottom. And it's recognized with prices opening at the same level as yesterday, but closing higher with the same high as the previous bar. So it closes higher, and it's the same high as the previous bar. Okay, so we have reversal bars inside days. Okay, so we have a bearish inside day that occurs at the market top. And it's recognized with prices staying within the range of the previous bar. So it fails to make either a new high or new low from the previous bar. Okay, so this is inside days and you have a bullish inside day. So for bullish inside day, it occurs at the market bottom. Okay, so it's recognized with prices staying inside the previous bar, failing to make either a new high or a new low from the previous bar. Okay, other ones that we have, so apart from the inside days, we also have the outside days. So a bearish outside day occurs at the market top. Okay, and this is recognized with prices surging to a new high. So it's usually significantly higher than the previous trading day, and they will reverse lower and close below the previous bar's low, like this. Okay, so a bullish outside day occurs at the bottom of the decline. Okay, so this is a bullish outside day. So same thing, it's a reversal, but this is in a downtrend. And this is recognized with prices first collapsing to new lows, followed by recovery above the previous bar's high and close above the previous bar's high. Okay, so outside days have stronger signals than key reversals and two bar reversals. Okay, we also have reversal bars. We have spikes. So for example, something like that. Okay, so the spike is the only reversal bar signal whereby the color remains the same. So you can see that in all the previous examples that we go through, the second reversal bar, it's the different color. So if it's a bullish, like uptrend, the next bar, it's bearish. It closes lower, but for spikes, it's different. Okay, so you can see that the color remains the same. We can see this even in Japanese candlesticks as well. It's what we call doji. So you can see that it's very uncertain where the wicks are very long and the body is very short. Okay, so bearish spikes occurs at the market top, and it's recognized with prices surging to a new high, and it's usually significantly higher than the previous day, and they will reverse lower and close near the open level. But even though they close near the open level, you have higher, it's still higher than the previous bar's close. Okay, so there's a bearish spike, which signals a change in trend. And you have a bullish spike. So for a bullish spike, it occurs at the bottom of the decline. Here. And it's recognized with prices first collapsing to a new low, followed by a recovery higher and a close near the open level, but lower than the previous close. So for example, like this. Okay, so it still closes near where it closed previously, but it's still slightly lower. That's for reversal bar spike. And then we have the Japanese candlesticks. So candlestick analysis was first used in Japan in the 16th century. So I think this is the one that we are using. It's more common. Excuse me. Okay, so it was used by rice traders and is an attempt to forecast future rice prices. So just a little bit of background on the use of Japanese candlesticks and where it came from. So Japanese candlesticks are leading indicators because they provide early warning signals to possible price changes. Okay, and these patterns, right? So we have patterns that comprises of one candlesticks or more than one of them, and they help us to identify trend continuations and reversals. Okay, but just to share a little bit personally, I don't just trade on pure candlesticks. Okay, I know there's some people who just trade based on candlestick patterns, but I haven't found much. I haven't found it to be extremely effective, which is the reason why. But it really depends on your preference. Okay, so they are very useful, especially when you identify a key level, and along with that, you have other elements that line up with it. For example, like your moving average, support resistance lines that we covered previously, and along with this candlestick patterns. Okay, so I think it can be used more as a confirmation rather than just by itself. Okay, but that's what I think. It also depends on your preference. Okay. We also have, so let's see how's a candlestick being formed, right? So basically a candlestick is made up of, we have a rectangular part, and the difference between the open and the close is what we call the body of the candle. Okay, and we have the upper and lower shadows. So this is the difference between the body and the high and the body and the low. Okay, so we also want to take note the color of the candlesticks. So usually when you have a green candle, it just means that it's bullish. Okay, it means that the open prices are lower and close prices close higher than the open. And then for a red candle, it just means that it's bearish. Okay, it means that prices push lower. So you can see that your open prices are higher compared to the close. So when you want to analyze a candlestick, the first important element we have is the color of the body, which we covered. So we term a green candle is bullish and a red candle is bearish. Okay, we also have the size of the body, which is this one. Okay, so when you have a very large body, right? A large body basically just indicates that you have buyers and sellers that are winning. Okay, let me just do this first. So yeah, so this is the large body. You can see that either the buyers or sellers. So buyers if it's a green candle and then sellers if it's a red candle. So they are very strong. They have very strong buying or selling pressure. So for example, if we give an example of a large red candle, it shows that the sellers are clearly in control. Now let's look at a small body in this case. Okay, so if you have a very small body comparatively, it just means that you have a consolidation of price. So it's very unclear. You don't have a clear sign of whether it's a strong buy or strong sell. Okay, so no strong buying or selling pressure there. And there's no clear winner between the buyers and sellers. Okay, so that is the first thing to watch out for. The second thing we want to take note of is also the upper and lower shadows, which are the ones that we call the wick. Okay, so the wick over here, you can see the length of the shadow. So the longer the shadow, the more volatile the price action. Okay, it just means that because between the high and the low, right? So at the ends of the candle, it represents the range that price is trading within. So that candle represents the fluctuation in price. What is the highest point that it goes to and the lowest point in a particular time frame. Okay, so for example, if I'm on a 1 hour time frame and I have this candle, maybe the high it's let's say 20, low it's 5, okay, open it's 10 and close is 15. Then basically what I have is that in that one candle, in that 1 hour, right, price has reached 20. It has also touched 10. And in between it opens at 10 and then closes at 15, for example. Okay, so that's the range. Basically, the high and the low is the range that price is trading within. So the longer your wick, it just means that it is a larger range that price is trading within. Okay, so we have various combinations. You have your color, your body size, and the shadow length that can be analyzed to predict future movements. Okay, so the lower shadow, the upper shadow here. Okay, so another way to read this candlesticks is that basically the wicks represent strong rejection of that area. So you can see, for example, if you have a very strong bullish body with very little wick, it represents strong, right? So buying and selling pressure. But if you have a wick, for example, that has a really small body and very long wick, it just represents that maybe when price spike to a particular area, there's a strong rejection of this level. Okay, so we'll be exploring further into that later on. Okay, so the first type of candle that we have is the doji candlestick. So what is a doji? So over here. So this is what a doji looks like. So dojis basically, they have no body, okay, mainly because then the open prices and closed prices are very close together, or sometimes they are the same. So what this means, it's also that it suggests indecision. Okay, so basically there is a struggle between the buyers and sellers, and they are considered neutral patterns. So basically, when you see a doji, for example, right, usually it represents indecision. Okay, so any bullish or bearish bias depends on the power trend of confirmation coming from the candle after the doji. Okay, so yeah, so this is what a doji looks like, and this is what they represent. Okay, so any bias depends on the power trend. So which means that if it's bullish, it's likely to continue. in a bullish direction. Maybe you see a doji when it reaches a key resistance level and you see a slight pullback. Okay, so basically it represents indecision. People are not sure of where the prices are going next. Okay, so while the doji is the name that's given to any candle that shares its open and close price, the length of the shadow may vary. Okay, so you have different types of doji depending on the length of the shadows that we have. So if you have a doji that has relatively small shadows, okay, so for example, you have a really small shadow. So shadow, remember, it's the wick. So it just means the wick. So in this case, if you have a doji with relatively small shadows, it's what we call a classic doji. Okay, it's the typical one that we see. And then you have this doji where you can see that the wick is much longer as compared to the classic doji. Okay, so in this case, this wick, it's what we call the long leg doji. Okay, it just means that within the range, you can see that maybe for more volatile pairs, they are trading within a much larger range because the open and close prices are higher. Okay, the range between them, it's much higher. And then we have this, which is what we call a dragonfly doji. Basically, you have no upper shadow, but a very strong, long lower shadow here. So this is a dragonfly doji. Again, the wick represents that maybe price touches or it taps a really strong support area, for example, and you're seeing strong price rejection of this area. Okay. And then a doji with no lower shadow, but a very long upper shadow. It's what we call a gravestone doji. Okay, so same thing with the gravestone doji. It could be in an uptrend. So let's say a strong uptrend where its prices are close to resistance and it taps this strong resistance area. Maybe you see Fibonacci confluence levels there. Okay, so basically at that point, there's a strong rejection of that level, okay, especially at the spike. So that could be an example. Okay. So candlestick patterns can be very popular when you look for the tops and bottoms in the markets. Okay, so one of the other patterns that we have, which is a popular reversal pattern. Okay, so this popular reversal pattern we have, it's called the bearish engulfing. So the bearish engulfing candle here. Okay, so bearish engulfing candle, where can you find them? Okay, so bearish engulfing candle, they're usually formed at the end of an uptrend. Okay, so they're considered a bearish signal because you're expecting a trend reversal. Okay, so how does a bearish engulfing candle look like? A bearish engulfing candle, basically, you see that the next candle, which is the red candle, right? It engulfs, so which means that the whole body would cover the previous green candle. Okay, so it just means that over here, there is strong selling pressure. Okay, so of course, you want to combine it with other elements. Okay, so for example, if price reaches a strong resistance area where we are expecting reversal because it is a level that has been tested multiple times, and when we see these patterns form, it gives us additional confirmation that prices are pushing lower. So basically, for bearish engulfing candle, it just means that at that particular candle, you can see that there is strong selling pressure, maybe because a certain price has been reached, and that body itself would cover the previous candle's body. Okay, so that's a bearish engulfing candle, and the red body form opens higher and closes lower than the previous candle. So as the word suggests, it engulfs. Okay, you also have a bullish engulfing candle. Okay, so in this, you usually find it in the end of an uptrend and prices are reversing, so it pushes lower. And we also have bullish engulfing candle. So for bullish engulfing candle, it's the other way around. Okay, so bullish engulfing candles, they are usually formed at the bottom of a downtrend, and they are a bullish signal. Okay, so for example here. So it's a bullish signal where basically the green body form opens lower and it closes higher than the previous red candle. So similarly, in a bullish engulfing candle, it's different. So it just means that it's an end of a downtrend, the bullish pressure is strong. Okay, so you have a strong buying pressure over here where you have a lot of buyers that are willing to buy at this price, and it engulfs the red candle. Okay, so that is for bullish engulfing candle. At the same time, also, we see that we want to combine this with other elements. So just looking at candlestick by itself may not be the best, because you can have a lot of noise in the market depending on the time frame that you're on. If you're on a larger time frame, maybe not so much. But if you're on, let's say, a 15 minutes or 30 minutes or even 1 hour, sometimes it can get very choppy. Okay, so I would suggest that if you want to use candlestick patterns, you want to consider also other elements involved. So for example, you want to consider, let's say, strong support area over there, okay? Or even moving average. If price is holding above moving average on the trend, it's still bullish, then yes, that would help. Okay, I have a question by Casey. Do we consider, hold on, let me just click this. So do we consider covering only the body to include the wick of the previous candle? Okay, so, so I would say that usually this bullish engulfing candle, it covers the whole thing. Okay, so preferably it covers the whole candle, the previous candle. Okay, so that includes the wick of the previous candle. Okay, so that's bullish engulfing candle. And yeah, so basically a green body is formed that opens lower and closes higher than the previous red body. Okay, so that's a bullish engulfing candle. Okay, we have the piercing and dark cloud patterns. Okay, so piercing and dark cloud, it's a bearish pattern. It's usually found at the end of an uptrend. Okay, so for example here, so the first candle, it's a strong green body that we see, and the next candle opens above the previous high, but eventually closes lower than 50% of the previous green body. Okay, so the piercing pattern is formed at the end of the downtrend and is considered a bullish signal. So this is a dark cloud. Okay, so then you see that when price closes below, it pushes lower. Okay, and then we have a piercing pattern. So this is formed at the end of a downtrend and is considered a bullish signal. So for example, here. Okay, so same thing. You can see that the last candle, it opens sharply under the low of the previous candle, but comes up closing above 50% of the red candle body. Okay, so basically same idea. I think it's basically targeting a strong rejection of that particular area, and it closes much higher. Okay, but in combination with this, because it can look like any other candlestick, so you want to combine other elements along with it, or maybe if price breaks the previous high, and make a retest before entering along in this example. Okay, so in the piercing pattern example. Okay, so that's the piercing pattern. Okay, so we also have morning and evening star patterns. Okay, so these are the more common ones that we have. So these are usually found at the end of an uptrend. So for example, okay, so at the end of an uptrend, you have a bearish signal here, which is the evening star. Okay, so the evening star, or what they call the planet Venus, occurs just before the darkness sets in. Okay, so this is basically how it looks like over here. Okay, so you have, for example, in a bullish trend, you have one bullish pressure that's pushing up, and then one small one at the top, okay, which shows that, bullish pressure is decreasing before reversal. Okay, so this pattern consists of 3 candles. You have a large green body followed by a small body, which can be green or red. Okay, it can be any color. Basically, it just shows that pressure, it's very uncertain. It can even be a doji where, it shows indecision, uncertainty, basically. Okay, and the last candle that follows, the third candle, is a red body, which signals the end of an uptrend. Okay, so it closes well into the green candle body. So this is what we call evening star, which basically means that prices are ending. So in the uptrend, we are expecting a reversal in price, so evening star. And you also have the morning star. So morning star is the exact opposite of the evening star. Okay, so we'll go into that as well. So this is, for example, so for morning star, it's formed at the end of a downtrend and usually it's a bullish signal. Okay, so morning star, it's usually a reversal. So you see at the end of the downtrend, again, you have a small, so you have one bearish candle and then the next candle that form into small body. Okay, it can be any color. And the third candlestick is a green body. It closes well into the large red candle body. Okay, so this is the morning star and it signals reversal. It could push higher. Again, it will be better to combine this with other elements. Okay, so that you don't just look, if not anything can be a pattern, because at that point in time, we wouldn't know where exactly is the reversal. Okay, so if we do a back test of it, yes, a lot of it's on hindsight, but and when you're looking at it just by the patterns by itself, I think it's better to combine them with, let's say, graphical support, resistance levels, things like that. Okay, so yeah, so that's a morning star. And then we have a shooting star. So shooting star is formed at the end of an uptrend, is considered to be bearish. Okay, so shooting star and hammer patterns. Okay, so for example, your shooting star here, you have a small red body with a long upper shadow and a very small or no lower shadow, basically. Okay. And the hammer is formed at the end of a downtrend and is considered to be bullish. Okay, so small green body, long lower shadow with no small, no upper shadow. Okay, so these patterns require further confirmation, which could come from the following candle. So again, you need to look at the third candle for confirmation. If not, it can just be any candlestick formation, right? It's just normal candlesticks that are being formed along the way. Okay, so again, I want to emphasize, you want to consider putting this together with other elements like graphical support resistance levels, okay? Because a lot of it when we do backtests is on hindsight. Okay, so we have the candlestick patterns that we have covered, okay? Now let's try and filter out the entry signals as well as identify the reversal patterns or reversal candles. Okay, so a candle. Okay. Okay, so a candle is made up of rectangular parts that we covered, right? So we have the difference between the open and close over there. So I've covered this one already, but we talk about the different size of the body, the different colors, right? If it's bearish, it's red. If it's bullish, it's green. Okay, and the length of the shadow. And we talk about the length of the shadow and how it can be bullish or bearish. Okay, so a large body candle basically represents that buyers are winning, and you have a large red candle, it represents that sellers are winning. Okay, so you have different combinations of them. Apart from this, they are also used as extra filter for further confirmation before entering a new trade or even closing an existing one. Okay, so some of this candlestick patterns, okay, they're not covered. So I'll be going through a little bit deeper into detail. So I think we also have 3 white soldiers and 3 black crows. So those, they're continuation patterns. So we have a few of them. So I'll be covering them later on as well. Okay, so just know that for now, the patterns can be used as entry and exit filters. Okay, so you want to enter a long position. So basically you want to buy above the high of the candle or the upper shadow. So this is especially useful, especially when we have a case where, you know, prices are reaching, you have a bullish outlook on maybe a certain currency or certain stock. But right now, prices are kind of testing resistance. So we want to wait for a break above these levels and also a break above the previous high, okay, before entering a long position. So that's how we use this, okay? So for example, in this case, and in this example that they gave us is a short position. So if they want to enter a short position, we want to sell below the low of the candle. Okay, and it's especially important if prices are actually testing a strong support level, because then if I'm waiting to sell or if I want to short the market, I want to wait for the break below this level before it triggers a further push down lower. Okay, which is the reason why, especially when you have not just this candle by itself, but when you have maybe, let's say, a lot of elements lining up there, which represents a strong support, you want to wait for the break below this level and a retest before pushing lower. Okay, so the same filtering technique applies for stop losses as well. Okay, so for stop losses is the opposite. So we want to identify as many elements as we can over there, especially in terms of candlesticks. We want to place our stop loss just slightly above the key, the high, basically. If you're trying to sell, you want to place the stop loss slightly above the high of the previous candle, okay, or where you would identify a strong resistance or graphical level, for example. Okay, so if it's a strong resistance level, then we are not expecting price to break above that level. We want to put our stop loss just slightly above this. And it's the same if you're intending to buy as well. Okay, so if you're intending to buy, it's a green candle, you want to put your stop loss just slightly below the key support, or basically the low of the previous candle. Okay, so we have reversal candles as well. Okay, so reversal candles, they can be useful triggers when searching for an entry signal, okay, since they indicate a shift in momentum. So for example, if you have price, so let's say over here, right? So in the first scenario that we see, so one example of reversal candle, if you have a strong uptrend, okay, where basically price was rising, then we have the right setup for a short trade, right? Because you can see here, first thing first, you have a doji at the top, okay? So, or rather a hammer. So in this case, it shows there's a lot of uncertainty because your body is really small, okay? And also the bearish reversal candle, it's a candle that closes 50% below the body of the last bullish candle. Okay, so in this way, you have the reversing price action of the last green candle. Okay, so this is one example. So in this right setup that we have for a short trade, the last trigger could be the formation of a bearish candle. Okay, so you want to short this position, it has to be executed below the low of the candle. Okay, so look at pattern number one. You see, you notice how the bearish candle closes below the 50% of the previous bullish candle. Okay, so that's what we consider a bearish reversal candle. That's for pattern number one. Okay, let's look at pattern number two. Okay, so pushes lower. We have pattern number two. So in pattern number two, right, we have the bearish candle. See this one? Okay, so the bearish candle closes 50%, below 50% of the previous big bullish candle, and this is considered a bearish reversal candle. Okay, I do have to caution that just by itself, I think this might not work because you can have a case where it's just a strong uptrend and prices are just retracing back before pushing higher, which is the reason why it's also important that you need to combine it with other elements, not just look at it by itself like this, because we can have a lot of noise in the market. So in this case, you can see, okay, so it closes below 50% of the body. So that's for pattern number two. Of course, we need to combine it with other indicators or elements. For example, if you want to do graphical levels or even retracements, extensions, things like that. Okay, so that's for pattern number two. And then we have pattern number three. So in pattern number three, okay, the candles does not manage to close below the midpoint of the previous significant bullish candle, and it cannot be considered a reversal candle. So for example, right, so in this case, you can see the candle doesn't close below the midpoint of the previous one. Okay, so it's not reversal, it could continue pushing higher. This pattern can be mistaken for a bearish engulfing as well, which is the reason why it's important to know that at that level, if it's not a key graphical level, it could continue on its uptrend. Okay, so you can see over here, in pattern 3, okay, so even though it doesn't close below 50% of 2 candles below the green candle, you can see that the red candle actually engulfs that green candle, which is the reason why it can be very misleading. Okay, so that's for pattern number 3. Okay, and pattern number 4, you can see, so the pattern number 3 is basically neutral. Okay, and then we have pattern number 4. For example, okay, so in pattern number 4, you notice that the second bearish candle is acting as the reversal candle compared to the previous significant bullish candle because it managed to close below 50% of the green candle's body. Okay, so basically the idea behind all of this is to show that even if the reversal candle was not directly, it may not be the direct candle after the previous candle. Okay, so it might not be directly after the significant bullish candle. As long as the market failed to continue higher, the large candle can be considered a reversal candle. So the idea of an uptrend is that prices continue making higher high and higher lows. Okay, so if price failed to continue making that higher highs or higher lows, we could be seeing a change in trend. Same thing in a downtrend, prices are expected to push lower and lower, right? So which means that you form higher lows as well as lower lows. Okay, so if those conditions are not fulfilled just by itself, okay, and you draw, let's say, a trend line, a break of a trend line, it could represent a change in trend. Okay, so you can see for the 4th pattern, it's bearish. Okay, so bearish reversal candles that we have. Okay, we also have same concept, but in this case, we're talking about a bullish reversal candle. Okay, so bullish reversal candle, basically, you have the candle closing 50% above 50% above 50% of the body of the last big bearish candle. Okay, so let's say the last big bearish candle that we have is here. You want to have 50% of the body. Okay, it pushes higher, 50% higher. Okay, so in pattern number 1, you notice how the bullish candle closes above 50% of the previous big bearish bullish candle. Sorry, bearish candle, yeah. So you can see the green candle basically pushes or closes 50% above the red one, the previous red one. Okay, so that's the first one. It's considered to be bullish. Also at the bottom, you can see over there, there's a lot of uncertainty, right? Where you have a very small body and a huge wick. Okay, so below that whole green bullish candle, the 50%, you have the other one, but you have a very big body over there. Okay, so in pattern number 2, so you have bullish reversal candle, and pattern number 2 here. Okay, so you have a strong downtrend, and the bullish candle closes above 50% of this. Okay, so it closes above. And this is also considered a bullish reversal candle. Again, I want to reiterate that this might be a little bit misleading, especially if you have still a strong downtrend. It could just be a pullback before continuation. Okay, so something for us to keep in mind as well. Okay, so we want to make sure that we combine other elements there. So if it is a strong support level that you're looking at and we see this pattern being formed, then yes, by all means, it could potentially add on to it. So further confirmation, basically. But just by itself, I wouldn't trade it just like that. Okay, so that's for pattern number 2. For pattern number 3, so this pushes higher. Okay, so for pattern number 3, let's look at pattern number 3. Okay, so for pattern number 3, the candle didn't close above the midpoint of the previous significant candle. Okay, and it cannot be considered a reversal candle. So for example, this is pattern number 3. Okay, so pattern number 3, you can see that this candle didn't close above the midpoint, so we will consider this to be neutral. Okay, and then this is pattern 3, and then we have pattern 4. Okay, so pattern 4 over here. This is bullish. Why? Because in pattern 4, you can notice that the second bullish candle, right, over there, it's the reversal candle, but it's not directly. So it's not the next candle that's the reversal candle, but it is a candle that managed to close above 50% of the previous big bearish candle. Okay, so it closes above and you have strong bullish trend. Also, in combination with this, you can also see other reversal patterns being formed. For example, you have the 3 white soldiers, where basically you have 3 strong bullish patterns formed. Okay, so yeah, so that's what we have for the slides. I'll just be going through a table of the different candles, the ones that we didn't see over here. Okay, and if you guys have any questions, just please put them under the questions tab. And then when we have time later on, so we have some time, so we'll just hop onto the real chart and try and find these candles and also identify their support and resistance levels to see if it does work out. Okay, so yeah, so I'm just gonna pull out so you can see on pattern 4, it's bullish. Okay, so bullish reversal candle. Okay, so I'm just gonna pull out the other chart patterns that we have that might not be in this slides. Okay, so I'm just gonna show you baby pips. Okay, for these candles that we see that are also important, but we don't really see them here. So let me just show this. Okay, can you guys see my screen? Okay, so just a few of them that we have. These are the common ones. Okay, so those are not covered in the slide. So we have the single candles, okay, or rather the number of bars, they are single bars. So you have the tops, so spinning tops, they are neutral. So basically it works pretty much the same idea as the dojis, but in the dojis you have much smaller candle body. In this, the spinning tops, the body is okay, but it's still very small relative to the wicks. Okay, you have your doji where you see that basically it's just one straight line because the open and close prices are the same. So this basically represents uncertainty. It's very neutral. Okay, and then by itself, this candle itself, if it's it can be a white candle or a green candle depending on the setting of the chart. If it's a white marubuzu, it's bullish, and then same thing if it's black, it's bearish. Okay, we have the hammer which we saw just now, basically huge indecision at this point. Usually this comes with other elements as well. Okay, so let's try and find them on the chart later on. Okay. Yeah. Okay. You can see them now, right, Candy? Okay. Okay. Thanks for the heads up. Okay. So that's for hammer. So basically, hangman, it's the opposite, bullish and bearish, and they represent huge uncertainty. So you're looking at a reversal in a trend with a lot of indecision at a particular point. So again, I cannot emphasize more that this has to come with other elements, not just by itself. It has to be with a combination of other elements. We have inverted hammers as well. Okay, so inverted hammers over here where you have a strong downtrend and then you have a rejection above this level. So I tried to test the resistance. There was a rejection before pushing higher. For bearish, you have your shooting star. So this one we covered already, okay, in the slides. Okay, so the one that I think we didn't really cover much, it's the spinning top. And also, okay, bullish and bearish engulfing candles were covered over here. So basically you want the whole candle to engulf the previous one. Okay, tweezer tops was not covered, so this is something interesting as well. So for tweezer tops, basically you have a point where it's like a double top, but you have a very small body and also wick. Okay, so basically you see that price, right, try to test the resistance level twice, fail to break above it. We are seeing a strong rejection of that particular level. So that's with tweezer tops, you can see here. Okay, so rejected both highs, fail to break above before pushing lower. So I think it works pretty much similar to the idea of a double top and double bottom. Okay, so same thing with a tweezer bottom, same idea. It works, fail to break above it before pushing higher. Okay, so in this case, if you see a candle like this being formed, along with other elements confirmed, okay, it helps in the confirmation. Morning star, we covered it already. Evening star, we covered as well. Basically, a change in trend. In the middle, you have like a spinning top, or maybe like a doji, which represents uncertainty before pushing lower. We have 3 white soldiers. So this was not covered in the slides. So 3 white soldiers basically just means that when you have a pattern being formed, okay, or maybe a change in trend, along with this confirmation, you have this 3 very bullish candles, okay, which represents that, okay, we could be seeing a bottom or a change in trend to uptrend. And you have 3 white soldiers, or basically 3 bullish candles that represents that. Three black crows, it's the opposite. Okay, so you're talking about a reversal or bearish trend where prices are pushing lower, and this is represented by strong bearish pressure. So that's for three black crows and three white soldiers. These are the more common ones that's not covered. Three inside up. Okay, so basically you have a black candle and two green candles and a reversal. And then for three inside down, it's the other way around. Okay, so you have a green candle and then two black candles that represent this. Okay, yeah, so that is basically candlestick formation patterns. Let's try and hop on to the real chart and see if we can see them. So I'm just going to log into TradingView. Okay, and let me just bring this window up in a while. Let me just log in and we'll get there. Okay, so let's see. Okay, so let's see over here. So I'm on a weekly chart. Let's just see what we can find on the weekly chart. Okay, so something interesting that to share is that when you have, for example, a strong reversal of this level, usually what happens is that it's accompanied with a double top or double bottom. Okay, so I'm just going to show you guys. Let me just switch it in close and see if I can see anything. Let me just bring that up. It's just something interesting that we saw along the way. Okay, so let's see. Okay, so for example, okay, let me just go on to the daily. Maybe it's less choppy on the daily. Okay, so for example, over here, right? You can see over here, this is the high, right? On top of the high, we also have this. So you have a double top pattern that's being formed. And at the same time, along with the double top pattern, over here, you can see that, so you have a resistance level. So I'm on the daily chart, okay? So on the resistance level, here you have a double top pattern. So where price tested it once, okay? So at this point, we wouldn't know whether it's a reversal or not because it's a first reversal. So this point, you can see second double top pattern being formed. And within the double top pattern, something else that's interesting to note is that you can see over here, this red candle, right? So this red candle that we see, it covers the previous green candle. You can see here what they call bearish engulfing candle. So it's very strong bearish pressure that we have over here because this is the green candle, the body of the green candle. In fact, the whole candle, this red candle completely engulfs it. So this is what we call bearish engulfing candle. Okay, over here. Usually it's a reversal pattern because you want to identify other key patterns here as well. So it's particularly useful when you see something like that along with a double top being formed here. Okay, so we already identified that it's a resistance level on the daily, just based on pure graphical level. When you see a formation like this, right, along with the break of the trend line. So if you go on to the H4, you see a break of the trend line. Okay, so you see the break of the trend line over here. It more or less confirms the drop. Okay, so yeah, so this is something else that we can take note of. Usually it's the pattern, right? Especially if found on a larger time frame, would be more reliable as compared to the ones that you find on the smaller time frames. Okay, and let me just show you an example on that. So for example, if you go on to the 15 minutes time frame, not saying that these patterns won't work, but it can be a little bit more more misleading. Okay, sorry, I just lost my words there. But yeah, it can be a little bit more misleading. So for example, okay, so in this pattern, okay, so something else to take note of. Here you can see this reversal pattern as well. Strong bullish uptrend. Okay, and then you have doji, very clear doji over here. So I'm looking at this pattern basically. Okay, so at the end of the reversal, you have a strong push up. Okay, price failed to break the previous high. Something else to take note of is you can see here, this was the previous high, right? So let me just remove that. Okay, so there was a strong rejection of this level already. So you can see when there was a strong push up, but this pattern hasn't been formed yet. Strong push up, there was a strong rejection of this level, right? You can see this represented by this red candle here. Strong rejection of the previous high. So usually when the pattern is formed, right, this is taken out. So this is also what we call stop hunt setup. It's meant to spike. So if we saw strong rejection here, right? What people do just based on trading, based on graphical levels and even candlesticks, they try to short and put the stop loss slightly higher. So this is when we saw the reversal pattern being formed, where basically you have a bullish candle, right, and the doji, which represents huge uncertainty before a bearish engulfing candle here. You can see it is a very strong red candle. Okay, so this is actually the same as the evening star. You can see in this example. Okay, strong green candle, uncertainty, and a bearish candle. Strong green candle, uncertainty, bearish candle. Okay, so then it pushes lower. Okay, you can see that this is a reversal pattern, it's bearish. Okay, so not saying that these patterns don't work, but most of the time we do need to combine them with other indicators. So for example, I'm on the 15 minutes, you can see that it was the previous strong graphical level as well. It has been rejected strongly off this level once. Okay, so what we want to do is to wait for the pattern of this being formed before pushing lower. Okay, so yeah, so that's what we have in terms of the evening star. Okay, you can see it here again in this pattern. In this case, this is not an evening star. Okay, so this is, so you can see red candle, green candle, uncertainty, and another green candle. So we're looking at a morning star. It's a bullish pattern. Okay, so you're looking at a change in trend, basically red, indecision, green. Okay, so you can see here red, indecision, green, and also again, I cannot emphasize the importance of combining with other elements. Okay, so for example, in this case, you can see it was a previous strong support level. It would have been better if it's on a larger time frame. Okay, and it was a trend line as well. Okay, and then Fibonacci retracement for those of you guys who attend the exclusive webinar series. Okay, you can see here. $61.8 retracement. Okay, so yeah, so you do need to combine it with other indicators as much as we can. Okay, or even if you see like Fibonacci confluence levels, you try to draw as many to find basically this area, and you can see that this area was a previous strong support turn resistance level, or rather resistance turn support level, this area here, right? Why? Because price failed to break past this level multiple times. You can see just based on candlestick patterns. Okay, price failed to break past this, it held as resistance many times. And then over here, it was represented by a strong break. So it represents buying pressure. You see strong buying pressure over here. And when price push higher, we are expecting a retest, right, of this previous resistance turn support level before pushing higher. So when you have something like that in combination with the candlestick pattern that you can see highlighted here, then yes, okay, this can be very useful in identifying the reversal pattern. But again, I wouldn't just trade it based on pure reversal pattern. I will also look at, for example, graphical levels. Okay, so like support turn, resistance areas, things like that. In mind if there's a trend line or Fibonacci retracements, that can really help. Okay, so yeah, so that's an example of a morning and evening star. Okay, so a lot of time it depends on the graphical levels as well. Okay, so let's zoom in. So I think you can find this pattern almost everywhere. Okay. Okay, so you have another one over here as well. This is just bearish engulfing. Okay, but again, by itself, it will be very hard. So it can be very misleading. So this is a bearish engulfing. You can see that it's much significant. The high is much more significant compared to the previous high. Okay, so what can be misleading is, for example, if you have something like this. Okay, I wouldn't call this a very strong bearish engulfing, okay, because the high seems to be similar. Okay, so just something for us to take note of there. Okay, so yeah, you can basically find the reversals, pretty neat reversals somewhere. And okay, so here, you can see here, you can see this pattern. It was a previous downtrend. Okay, so zoom into these 3 candles, the reversal point. So you have a red and then a doji, right? And then a green. So again, this is the red, doji, green, the morning star. You can see here. But what's even more important than that is that you have your strong support turn resistance, or rather resistance turn support, right? It was the previous graphical level. Why? Because it was the previous strong resistance. You can see price failed to reject this. If I have to stretch this line across, this line, you can see this line, right? It held as resistance so many times, 1 times, 2 times, 3 times, 4 times. And then when price finally broke above it and retested this level as a support, and you see this confirmation, then yes, it will push higher. So I would say that if I were to use this candlestick patterns, I would use it more for confirmation rather than just trading them by themselves. Okay, so that's what I meant by that. So you can see that you need to identify these graphical levels as well. So it's a previous resistance and support. And when you see a reversal pattern over here, then yes, okay, it's very useful in identifying them. And also if you do a retracement level, so if you're familiar with retracement, swing low to swing high. Okay, so it will really help to find that there are key retracement levels over there. You can see the 50% here. Okay, so it's a previous resistance turn support, you have a retracement level and you have a pattern. So it adds on to the confirmation. So yeah, so that's how you can use them. Okay, so this is it's a clearer example, you can see. So basically it's very useful when you have key graphical levels, okay, but not so much if you're just playing the pattern by itself. Okay, I think it can be very misleading. Okay, so yeah, so it's important to find key graphical levels before playing this. Okay. Okay, so do you guys have any questions? Okay, so if you guys have no questions, I think that's all the time that we have for today. Okay, so the key takeaway from here is really just to know that okay, thank you, Casey. Okay, so just know that when you find this reversal pattern, try as much as possible to look for graphical levels. For example, support turn resistance levels or even trend lines. Okay, so basically this was covered in the previous topic, okay, that we have. So basically look for key support resistance levels, combine this together to get a more confirmation. I would say that this adds on as confirmation, but not just purely by itself. Okay, so with that, we'll end today's webinar. Thanks everyone. Stay safe, take care, and we'll catch you guys tomorrow. So for tomorrow, we'll be having our exclusive webinar series. Okay, so first half, we'll be going through key news events and then also the key economic calendar and news to watch for today. And then for that tomorrow. And also the second half is the technical session. Okay, so stay safe, take care, and we'll catch you guys tomorrow. Okay, thank you so much, Gerald. Okay, so it's been a pleasure. See you guys tomorrow.